Welcome back to Real Estate Mindset. Good morning, you guys. This is going to be absolutely bonkers. We're going to do a full deep dive into what's going on in the real estate and housing market today. But before I begin, I wanted to say good morning to everyone. Liam, good morning to you. Christy, it's nice to see you. Mary, nice to see you always. Dean, nice to see you. Knight Cree, nice to see you. We are blessed. I am blessed. Julius, nice to see you. The Cold Reaper, Florida Beach Bum. Good morning to all of you. There's my man, Mark. Mark, I love hearing from you, brother. William, nice to see you. And BRM. Ricardo, there's our man, Johnny. Johnny, when are you going to start doing podcasts, man? We want to listen to your perspective. At least I want to listen to your perspective, Johnny. I absolutely love it. Anna, how are you? It's so nice to see you. So nice to see you as well. TW, Joe, Christopher, Elijah. Man, Steve-O's here too. Joe, TW. Man, I love you guys. You guys are some of my favorite people. So I'm going to get started, you guys. I have a really good value-packed live setup for you guys today. But, first thing I want to say is I hope you guys had a great 3-day weekend. I know I had an exhausting one. I almost said babysit. They're my own children. So I watched my kids all weekend completely solo. I did take them to the movie theaters. We watched Ninja Turtles, Teenage Mutant Ninja Turtles. Surprisingly entertaining movie, you guys. So, I was really proud of myself because my children are 7, 6, and 4. So, I got them to the movie theater. We got all the popcorn. We got the soda. We got the candy. I'm feeling like an absolute stud. People are like, bless your heart, bless your... Meanwhile, my wife does this every single day. So people are respecting me, but meanwhile, my wife's an absolute champion. So anyways, we get to the movie theater. I have all the seats lined up. Like, here's your box. Here's your popcorn. Here's your candy. Here's your drink. And then as soon as everything is calm, movie's about to start, my 4-year-old looks at me and says, Daddy, I got to go to the bathroom. Y'all, when he said that, my heart sank because what are you supposed to do, right? Anyways, he had to go to the bathroom. But I ended up obviously calming down because the thing is, guys, is he needed to use the bathroom. And that reminds me of the buyers right now that think that they need to purchase a home. The reality is, guys, is we don't need to do anything right now. And if we do purchase a home, we have to ask ourselves, would we be basically trading in our peaceful life, right? Potentially a peaceful life. Maybe we're able to save money right now. Maybe we're able to spend more time with our family. But if we purchase a house, we have to spend $70,000. Our payment goes up. We can no longer save. So in other words, what I wanted to say, guys, is definitely just put that in perspective. We need a roof over our head. Doesn't mean that we have to own it. Do we want to own it? Yes. Okay. But anyways, this is going to be value packed. Let me look at the poll. You guys, I sent a poll. Oh my gosh. I just looked at the results of the poll. I don't know how to look at the results after the podcast, but I asked you guys a question. Have you ever had a market analysis done? And only 25%. My gosh, you guys, 25% of you said that it was done. 75% said no, it is what it is. So let me tell you guys what I'm going to do today. All right. So I'm going to do a full market analysis. Market update. We'll look at everything, interest rates. And then after that, guys, I'm going to go into Redfin and I'm going to show you, this is absolutely bonkers. I'm going to show you what Redfin says the Houston market is. And then I'm going to access my local MLS and I'm going to show you what the real numbers are. And you guys are going to see what Redfin is saying because we've been digging in a lot to Redfin data, you guys. But their numbers are drastically different when I access MLS. And I'm going to show you guys that. And essentially the reason I'm telling you guys all of this stuff is we need to understand that we can't lean on anyone else like we can lean on ourselves, okay? Understand that there's multiple lawsuits going on with the National Association of Realtors. There's so much misinformation. There's so many different markets. My market is different than your market. Your market's different than my market. We have to learn how to trust ourselves, okay? That's what I'm really trying to tell you guys. You need to learn how to trust yourself and you need to have the confidence that you know how to find a great deal. So today we'll go over, the market update. I'll go over, the Redfin thing. And then we're going to go over a couple of videos of talking suits, but also I'm going to do, today's value is going to be a market analysis. And I'm going to be doing that. Let's see here. We're going to be doing that in the Spring Terrace. Okay, so we'll be doing that in the Spring Terrace here in Houston. Now, what happened, guys, is basically I had a viewer. I'm not sure if you're on right now. Are you on? Let me see if he's on real quick. But I had a viewer reach out to me. And Dennis, if you're on, you better comment, Dennis, because this one's for you. You guys like my light bulb right there? Anyways, so I had someone find me on Facebook. I don't know how you found me, Dennis, but he found me. He sent me an address and he's like, Travis, do you think this is a good deal? And you guys, my first question is always going to be the same thing. What's the market analysis say? So he didn't have a market analysis. He already has a realtor. So what I'm going to do is I'm going to be doing a market analysis on this subdivision that he's interested in. And we're going to take a look at if we can find some wedge and if we can find some cash flow. And we're going to do that absolutely live, you guys. So I hope you guys enjoy this live today. And other than that, we're going to get started. And if you guys can, don't forget to like the video. But we're going to start with interest rates. Okay, let me do my little timestamp. So if you guys want to come back, you can reference this. So here's where we're looking at. This is a beautiful thing, you guys. This is our 10-year treasury. And today it is up pretty drastically. It ended last week up as well. A lot of people saw it as crashing. There you are, Dennis. I see you, brother. Oh, it's not you. Darn it. It's a different Dennis. But anyways, you guys, so it went charging back up to end last week on Friday, I think about 8 or 9 basis points. It's up again today. A lot of people thought that this 10-year was going to crash down, including Johnny. But we can see that this is, at least while the Fed is doing quantitative tightening, this is appearing to be a new normal. And the interesting thing about this is again, this is where we were at when things started to break last year. And when things started to break, this year, and when those bank runs happened, obviously, guys, that postponed the recession. It postponed the recession because they had to do the bailout. But we're sitting at 4.24. That's nice. So it's about 11 basis points off of what it was. At 9 basis points because it was at 433. So we're close to being record high. Now, I suspect that this is going to continue to go up. I think this is going to continue to go up because why wouldn't it go up? And the more that goes up, obviously, guys, the more that people can't purchase homes and the less profit people make, like banks. So we want this high in the meantime. Now, once the housing market is balanced, I would be okay with interest rates in the 5%, not the 10-year. I'm talking residential mortgage rates. And here's where we're at with residential mortgage rates. We're sitting at 7.08%. This is going to go up today. All right, I don't know when they're going to update this. Probably, around 2 or 3 o'clock. I'm not sure. But when they update this, I'll put money on it, guys. I'm pretty sure this is going to be probably 7.2-ish. It only went up 1 basis point. And the reason that is on Friday is because there's a late day rally on that 10-year. So I don't think this is properly updated. I think the reality is loan officers and mortgage companies are going to be starting out Tuesday with what's called a pricing crisis in mortgage. And a pricing crisis is when we have a radical change to interest rates. When there's radical change of interest rates, like what's going on right now, it wrecks mortgage companies because they can't update their mortgages fast enough, or the pricing to the mortgage, or rather, what does it cost to sell an interest rate? That's called pricing. Pricing is everything when it comes to mortgage rates. They just don't tell consumers that. So we're sitting at 7.08%. Let's take a look, guys, and let me show you where we're at if you did buy right now by looking at this amortization schedule. A lot of you guys love this amortization schedule. You guys really need to understand how bad an amortization schedule is, how bad a 30-year fixed rate mortgage is. This is a huge lie. If you guys are learning one thing from my channel, I hope it's to trust yourself. I hope it's to use the data, but I also hope it's how bad these amortizations are, or these 30-year fixed rate mortgages are. They are so heavily front loaded with interest. It's crazy. It's not like a car loan. A car loan, we're able to pay the same amount in principal and interest every single month. But the way that mortgages work is it's front loaded with interest. So when we put the average interest rate of 708 in, and I put roughly the average purchase price with only a 5% down payment. So average home at a 5% down payment over 30 years is going to cost you $550,000. The home is only worth about $410,000. And yet your interest payment is going to be about $550,000. I also wanted to point out, guys, once again, if you put money down after closing, whether it's biweekly, whether it's one extra payment, whatever it is so helpful. As an owner that has a mortgage, you want to get past year 5 of your amortization schedule as fast as possible. So in this situation, if I put $20,000 down towards my principal after I close, not before I close, not at closing, after I close, it's going to save me about 5 years. Okay, you guys see that? So I put $20,000 down. It's a little bit more than $20,000 in this example. But by doing that, I remove the first 5 years of my amortization schedule, and I avoid all of this interest right here. I avoid all that. It's gone. It's wiped away because I decided to take my $20,000 and put it on my amortization schedule. And don't forget, you guys, that's your money. That money, as long as home values don't go down too much and you don't sell during, when it's bad, that money goes back to you. So like that 20, so you put 20,000, okay, and if you sell your house or you move or whatever, you get the money back. So you're not even really, it's not disappearing. You see my point here? That 20,000, you guys, that first 5 years, if you guys can knock that out, man, you guys are going to do so much better off, because you want to pay, when you're making these $2,600 payments, and this is just principal and interest, you want as much to go towards your principal as possible. But that doesn't happen. Look at the first year. The first year, only $3,800 is paid towards principal. And yet the bank makes almost $28,000. You guys, this is how it works. You guys need to be aware of the amortization schedule game. This is a horrible, horrible game. It's, in my opinion, that's the second worst debt in America, right behind credit card debt. It's the 30-year fixed rate mortgages, because again, you guys see how those work. Now, let's see what it would take as far as being able to qualify for an average priced house. So right now, you guys, sitting at that 7.08% interest rate, you would roughly need to make $145,000 right now. Okay. Now let me show you how I set this up. So here's obviously roughly the average price for a house right now. It's a little less than that. It just depends on the data set, but I'm using 412,000. Okay. So if you want to qualify, which I don't even know if I do anymore, if you want to qualify for the average house, you have to make $145,000. You guys, the average American doesn't make $145,000. I don't even make $145,000. Sometimes I get close with all of my jobs. Let me show you how I did this. This is assuming an $80,000 down payment. So in order to qualify for the average house, you have to make $145,000. And here's the big part, you guys. Not only do you have to deal with that higher mortgage payment, you have to cough up that $80,000 of liquidity. And if you were putting that $80,000 in, 1 month treasury bills, that's what per year? About $4,000 a year? Isn't that right? 4,000? Is that 4,000? 10% would be 8,000. Yeah, 4,000. $4,000 a year in income you would be sacrificing by using that money for down payment. Now, this is assuming the average consumer debt payments, okay? This is credit cards, a used car, and school loans. And you guys, here's the thing. When those school loans start, it's going to cripple purchasing power even more. But I wanted to show you guys $412,000, $145,000 if you're the average person. So in other words, you guys have to be above average. And the thing is, with being above average when it comes to your finances, usually that's only a couple of easy things you have to do. It's really, honestly, guys, like there's all these people that sell all these programs. Dave Ramsey, there's all these programs. People sell you to say, hey, if you spend $200-$300, you buy my program, you're going to learn how to be debt free. Okay. When the reality is, usually all you have to do is come up with a plan, understand how you spend money, and conquer your debts. That's usually all you have to do, you guys, is educate yourself. So you guys better be educating yourselves, okay? So let's go back to educating yourselves. To put this in perspective, if you want to be above average, this is what you have to get rid of right there. You have to get rid of that $1,400, which is consumer debt. If this consumer had no consumer debt, look at their purchasing power would go from 412 all the way to, let's see, 577,000. That is what, $162,000 in purchasing power? So if you guys are living in debt, if you have a car payment, understand you cripple yourself with purchasing power. Let me show you guys that again. Let me put the average consumer debt here. These are monthly payments. It goes from $577 to $412,000. I hope that hits everyone, because you guys really need to understand how this works. Now let's go into the CME Fed Watch tool. We have had some movement. The market is starting to anticipate rate cuts into next year. Now here's where we're sitting, guys. And I have everything broken down, so we'll get through this very, very quickly, okay? So CME Fed Watch, September, next, potential rate hike. Ain't nothing going on. They're only pricing in about 5% chance or likelihood, you guys, of an additional rate hike in September. So let me show you guys November, and really what I want to do is get to 2024. But November is down. Again, it's still, they're pricing in a 38.6% chance of a second rate hike this year in November. What am I talking about? Second rate hike, an additional 25 basis point rate hike. So they're only saying 38.6% chance with a 1.9% chance of a 50 basis point. And then we go here to December. We're sitting at a 35% chance of a 25 bip hike. And we're sitting at a 1.7% chance of a 50 bip hike. Let me show you guys January. You guys should take a little bit of comfort into this, okay? little bit of comfort. Now, here's January. January is basically saying, when we mix all this together, that we have an 83% likelihood that we're going to be at the same rates as we are right now or higher. Okay. So as far as January concerned, the market is saying 83% chance we're still going to be high interest rates like we have now. No rate cuts. Okay. 83% chance in January when all is said and done. Now, when we go to March, it goes from 83% chance down to 61% chance, which is good. So that means the market's pricing in more than half the likelihood that we're going to stay elevated. Now, this is very, very important that around March, especially March, that we have higher interest rates. And hopefully, I hate to say it, but we have recession because we need to batter spring home buying season. Okay, if that happens, we're going to be good. If that happens, you guys, if we go into the recession, if we can get through the seasonality next year, home prices will crash. Home prices will go down in many metro areas. Not all, perhaps not all, but hopefully you're learning on my channel. It's about location. And hopefully you're learning how to use data to figure out if your location is crashing, okay? But let me show you guys what May looks like. Now, May doesn't look that good. Now, May is basically saying 40% chance of a decrease in interest rates. Okay, so about 40% chance in May. Again, you guys, hopefully we can get to June. I think if we get to June, we're going to be sitting pretty, but June is only giving us 21% chance of having the same interest rates or higher. Okay, 21% chance in June. Now, July, here's what the market is saying for July. July, when all is said and done, is basically saying there's only going to be a 10% likelihood that we have rates where we're at right now or higher. So we only got a 10% chance, 90% likelihood by July rates will be lower, according to the market, right? Now, I'm not saying according to me. This is according to CME FedWatch tool. Really, really important to know the differences there. Now, let's go into our next segment of this video, which is really, really quite crazy. I'm going to show you guys what Redfin is saying. And then we're going to compare what Redfin is saying compared to what is actually going on in my local housing market. All right. Because the thing is, guys, is what I noticed well, first of all, I'm a realtor in Houston. Okay. So I noticed in Houston when I access my local MLS, and I've been showing you guys Kingwood, I've been keeping us in a small box in Kingwood because I don't want to confuse too many people. But when I go into Houston, and because I'm a realtor, I can access live data. I can access MLS data. So I don't know why it's taking me so long to do this, but I started comparing what's actually happening on MLS compared to what Redfin is saying. You guys, huge difference. There's a huge, huge discrepancy. So I'm going to show you guys this, all right? It's actually a little bit concerning how different this is. So I'm going to show you guys, here's Redfin Data Center. Before I go into this, I'm going to show you guys how to access it because I want you guys to be empowered and you can't just access it. So in order to even go to Redfin, you have to put Redfin News, okay? You don't just type in Redfin, you have to put Redfin News. See that? It has its own news thing right there. Okay, and then when I go to Redfin News, I'm going to be going to, where's my data? Here's the data center. And you guys could do this yourself, and I hope you do this yourself because I want you guys to trust yourself and be confident in your decision making. Now, what I'm going to do first, guys, is we're going to go into Houston. Let me show you what's going on in Houston. Pretty sure you guys are going to be blown away here. Now, first of all, let's see the active listings. It's loading right now. I don't know why. Of course, as soon as I start this segment, we have errors. Okay, so yeah, this is going well. So I'm going to pull this up, and what I'm going to do, you guys, is basically I'm going to show you guys the price cuts and the total active inventory on Redfin versus MLS, just so you guys know how much we can trust Redfin. Now, I've been very suspicious of Redfin, you guys, because they removed the data for 3 weeks from us, almost 1 month. And then they came out with the data and basically everything had plateaued. So I honestly, I don't think Redfin is reliable. I think the picture is way different than what they're painting. So I'm going to show you guys the active listings. Why can I not show you guys active listings here? It's just driving me crazy. So sorry, guys. So normally, Johnny, I see you in the comment section. Why is this happening, Johnny? So here's what I'm going to do instead. What I'm going to do instead is I'm going to try to fix this, and we're going to move to some videos so we can listen to some talking suits, unless this is going to start working. Is this going to start working for me? Yes. Unbelievable. Okay, it just started working, so we're going to go back into this. I'm so sorry, guys. Okay, so we're in Houston right now, and where I want to start is active listings. Here we go. Here we go, guys. Take a look. This is Redfin saying that active listings. Can you guys see this okay? Hope you guys can see this okay, because I'm about to show you guys something that I think is going to blow your mind. Okay, so here's Redfin Data Center basically telling us as consumers, and we've leaned on Redfin, they're telling us as consumers that basically in the Houston, Texas metro area, so they're actually going further than Houston. So in the Houston, Texas area, right now, this is saying that there's 23,464 listings. Does everyone see that? According to Redfin, latest report, in Houston, we have 23,464 listings. Okay, everyone knows that, right? Now, I'm going to go here. This is a wonderful tool that your realtor should be using. And if you're a realtor, you should be using this to help your clients. Now, what I'm going to do, guys, is all I'm doing is clicking active. Okay, so I'm going to click active. This is the HAR.com. This is the Houston Association of Realtors. So this picks up all the listings in Houston. So let me show you how many we have. Now, obviously, this isn't going to be 100% accurate because I'm not filtering it, but let's see how off it is. So again, Redfin said 23,000. Let's see how many active listings there really are. You guys see this? Do you guys see this? It actually went up. That's funny. No, it went down by 20. Do you guys see this? Okay. You guys see what I'm saying here? So thank goodness that I'm a realtor, and thank goodness I have access to my MLS, because the reality is we don't have 23,000 active listings in Houston. We have 34,600 active listings as of today. As the day you're watching this video, this live video, I'm pulling live data from multiple listing service that tells us that we have 10,000 more active listings than what Redfin is reporting. Do y'all hear me? Do y'all see this? 34,600 active listings in Houston. Again, it really frustrates me. Redfin is saying 23,000. We have over 10,000 more listings on HAR than on Redfin. Over 10,000. Let me show you something else. This next thing upsets me like even more. Take a look at this, okay? I'm really glad I have my license. This is price cuts. Price cuts are important. Price cuts are important because we need prices to go down. Therefore, we need price cuts. Okay? Look at this. This is saying right now, okay? This is saying right now for Houston, this is Redfin. This is not me. This is Redfin. This is not accurate. I'm going to show you what's accurate. Redfin saying, which is high. This is high. I'm not saying it's not. It's actually up year over year. This is good. But this is saying 7.6% of listings, you guys. Okay? And it was all residential, by the way, Scott. That those HAR is all residential, by the way. You guys are asking, was it all residential? Yes, it was residential. Now, here's the listings. Here's the listings with price cuts. Do y'all see this? 7.6%. Okay, this says 7.6% price cuts, all of Houston, Texas Metro. Let me go into the matrix, and all I have to do is click this magical button right here. Okay, that says price decrease. Right here. But first of all, okay, I want to tell you guys that this 7.6% represents 1,783 homes with price cuts. Redfin is saying there's 1,783 homes with price cuts. Okay, so I hit price decrease. Let's see how many there really are. Okay, I'm going to show you guys. Remember, Redfin said roughly, let's just round it up to 1,800 homes. Redfin saying 1,800 homes with price cuts in Houston. Let's see how many. Did y'all see this? 10,275 listings in Houston with price cuts. Did y'all see this? When I saw that number, I was like, what? You guys, we have okay. I hope you guys can appreciate the gravity of what I'm trying to tell you right now, which is basically the housing market's absolutely melting down. And as long as there's no black swan events, you guys, as long as there's no black swan events, this crap is going straight down again. All right, maybe not in every metro area, but it's going to start in certain places like in Texas. in San Antonio, Austin, Dallas, Houston, you guys, this crap is going to fall down and melt down right in front of our faces. It already is. It's already reared its head up. Why did it stop? Why did it rebound? Why was there that dead gap bounce or that rally? The $400 billion amongst other things, all right? This crap is insane right now. And by the way, you guys, just going back to here, remember what I said, okay? Redfin said 1,800 homes with price cuts. When I go onto MLS, it's 10,275 homes with price cuts. Okay, and I'm going to show you guys. You guys want to see? I'm going to show you guys. Now, okay, so that represents, you guys, 29%. 29% of the listings in Houston have price cuts. 29%, you guys. I'm just saying, this is the data. This is my active MLS right now. If you're a realtor, you can access the same exact thing. Again, all I'm doing price cuts. Let me show you guys some of these price cuts. I'm going to hit results. Okay, boom, 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 boom. Let's just see some of these. Boom, I'll go to listing. All right. So to the left of my picture, you guys can see some of the price cuts, and then I'm going to get started on some videos. But you guys see what I'm saying? I mean, holy smoke, we got 29% of the listings in Houston have price cuts. Y'all heard it first on my channel, okay? And another, 10,000 in inventory that Redfin's not reporting. Y'all heard it first on the channel, okay? This first home, 25,000 price cut. Let me see the next one. This one is 10,000. That one's 5,000, almost 10,000, 6,000, 10,000. This one's a nice one. This one right here, you guys, represents 33,000. This one represents what? 24,000. This one's 28,000. That one's nothing. This one's only 5. This one's 10. This one, they didn't know what they were doing. That one's what, 5. This one's a nice one, guys. This one's about 32,000. You guys can see that right here. So anyways, my point is basically, it's the same point I'm always trying to make. You guys need to lean on yourselves. Listen to me. I don't care if you're a realtor watching, especially if you cannot lean on anyone but yourself. There's no one that's going to care about your investment as much as you guys are caring about your investment. So you have to do the data. You have to, if you're not a realtor and you're using a realtor, you have to command them to do a market analysis, cash flow, wedge. You have to. And if you are a realtor, you guys listen, if you're realtors, no more cheerleading. We have to use the data. No more foolish optimism, reckless optimism. We have to use the data. I understand there's still people that need to buy. I get it. But help them understand what they're getting into, right? That's the point I'm trying to make if you are a realtor. Now, we're going to go into our first video, y'all. Right now, our first video is going to be from Yahoo, basically on professionals talking about shorting. So now we have talking suits, these bulls, all these bulls that were like, the housing market's, the housing market's great. It's doing well, new records. These guys are all changing their attitudes right now. Now they're like, you know what? Actually, yeah, it's going to be frozen. It actually may go down a little bit. They're all starting to change their attitude. Isn't that insane to you guys? Literally, like clockwork. As soon as we're out of that home buying season, here's the ugly head again. It's going to start crashing. So we're going to listen to this Yahoo video, and they're going to talk about what they're doing in the market. If you guys don't mind, please let me know that you guys, that the audio is okay, and I would definitely appreciate it. We'll get it started right now.
Buyers on going into Q4,
right.
Going into
Whoops.
All right, this is giving us a little bit of inclination to believe that we're going to see a strong holiday shopping period. Is there anything that investors could be keeping an eye on, or a top trade going into Q4?
Well, I think you raised a good point there, Brad. I think any of the consumer stocks going into the third quarter prints that we're going to see in GDP probably will get a good bounce. And if you make the bet that the Fed will stand pat, then those will be good places to put money. My own personal bias on a lot of the trades is on the short side right now. For example, bonds are starting to get overbought. We've seen that move yesterday from the JOLTS data and what we'll probably see here. So there'll be in any of the bond ETFs, there'll be a good short position you could do there. And if you look out over the horizon, 3-6 months, you could probably put on a good short position in anything around the housing market right now. Housing will get weaker, especially if interest rates get up higher than they are. Talk about what's going to be the impact of students having to repay their loans. There's going to be less money in the system. Savings have come down pretty substantially since just after COVID ended. So there's not going to be a lot of money to be put into the housing market, especially as things stay a little bit more expensive and rates are still high.
And Keith, we are still seeing a lot of people being defensive right now until they get a bit more certainty. But then, of course, you also had Grayscale's win over there with the SEC, perhaps lifting some appetite for some riskier assets. What's your take on sort of moving into some of these riskier assets? Well, it's still very early days for what happens next with Grayscale's spot Bitcoin ETF.
Yeah, it is. I mean, it's an interesting situation. I think broadly speaking, Rochelle, when you look at the digital assets and crypto market, which is what we play in at BlackCross, mostly in Latin America right now, is that we're still very early days. What I think is instructive about some of the recent developments and judgments that we've seen, especially yesterday with Grayscale, is that cryptocurrencies, digital assets are here to stay. The recent kind of right sizing of the market that we've seen since 2018 and the recent crypto winter and the failure of FTX, those are very positive for the marketplaces. And so there's going to be excellent opportunities both in the private markets and eventually in the public markets to invest in digital assets companies. I would not necessarily suggest that people should be throwing a lot of capital into the very risky and speculative tokens, a lot of them that you see out there. But try to look at things like a Bitcoin and Ethereum, some of the other tokens that actually underpin real business models and developments that are going to happen on the blockchain and in other areas. Those would be the appropriate places to put. And some people would deem those as risky bets, and maybe they are a little bit more volatile than buying a basket of 50 stocks in the Fortune 50. But those would be good opportunities to take some of your discretionary cash, put them into those situations, and watch them appreciate, because I obviously I'm a big believer that blockchain technologies, cryptocurrencies, digital assets, and all the innovation that comes along with that will accelerate dramatically in the next 3 to 5 years.
You guys like
We'll
crypto?
certainly be watching all of that.
I've never
Of course,
liked
everyone.
crypto myself because I don't, and I don't. I'm not going to give any stock advice. I'm not a stock advisor, but I just never believed in it. To me, it's just like I don't need to hide my transactions. I don't need instantaneous liquidity. I already have it. And I'm not a criminal, so I don't, anyways, it is what it is. I don't believe in that type of stuff. So let me show you guys what we're sitting at with the 2 and the 10 inversion. So here's the 2 and the 10 inversion. This is Fed economic data, 10-year treasury compared to the 2-year treasury. We know by now when this inverts, it's an economic signal of recession. And I just wanted to point out to you guys that we, as of tomorrow, we're going to be at our, I think it's tomorrow, the 6th. We're going to be at our 14 months of inversion. The average time of inversion before heading into recession is 15 months. Tomorrow, we will be sitting at 14 months. Thought you guys would find that interesting. Now, as far as what the direction of the reinversion is, really, you guys, we have no idea. I mean, there's really, I would say it is trending upward to reinvert. Now, if the 10-year treasuries keep going up, a lot of people think mortgage rates are going to be in the 8% this year. I'm one of those people. Many people think that the 10-year will probably get up to mid-4s. I don't know that it will get to 5, but maybe mid-4s. And it is reinverting. So, does that mean that there's a recession right around the corner? Probably. Now, let me show you guys what the market is viewing inflation as. Here's the 5-year break-even inflation rate. This is a set of data that the Federal Reserve looks at a lot. They want to make sure that the sentiment in the market is not unhinged as far as the expectations of inflation. They want to make sure that they have controlled market expectations. What's interesting is this went down pretty significantly Thursday, basically starting August 23rd. So for the last 2 weeks, this has been going down with a slight uptick on Friday. Now we're sitting at 2.17%. Once this chart right here, okay, this chart right here, if you guys want to know, get a better idea of what the Fed's going to do, just another indicator. Once this goes under 2%, then the Fed will start talking about lowering rates, cutting interest rates. But this has to be under 2%. Okay, as long as the Fed has the same goal. Now, let me show you guys something that's really crazy. The overnight repo. Okay, overnight repo continues to bleed money. They're losing a lot of money out of the reverse repo market. The reverse repo market is like the one-day treasury. This is where banks put all of our money, all of our deposits, 401ks, money market accounts. They take all of our money and they put it here for one day. And they get paid, I think, 5.3% for having their money here for one day. So what needs to happen is this money needs to leave here And basically, hopefully, they will purchase treasuries. And then the Federal Reserve, the Treasury, once they purchase the treasuries, once they sell the treasuries to all these people, hopefully they will burn the money and continue quantitative tightening. Do y'all understand? So we want this money to be burned. So we want this money to go into treasuries, and then we want them to burn the money after they sell the treasuries to the banks, to the consumers, to these people. And this is going down drastically. Now, I was worried because it was sideways in July. But again, it's going down drastically. I believe that one of the possibilities for this drastic decrease in the reverse repo market is it may be a sign that the market is anticipating like no more rate hikes. So they're fleeing now to the longer term yields, like 2-year, maybe 5-year. I'm not sure. So that's probably what that's representing. Not 100% sure. You guys, if you can comment, let me know what you think. We're going to go into our second video right now. And our second video is basically on experts sounding the alarm on the housing market. Okay. Sounding the alarm on the housing market. You guys, again, the suits are changing their narrative, and I hope you guys see that. And my gosh, I can't wait for the future because we're going to talk about all this type of stuff. I'm going to hopefully make tremendous amount of videos on why so many people missed what was happening right in front of their faces, but not you guys. You guys at least are aware of the possibilities of what's going on. If you guys can, please let me know that the audio is okay.
Well, the 30-year fixed-rate mortgage falling slightly to 7.18%, but still remains elevated. Inventory still remaining tight. Short supply is happening. The National Association of Home Builders sentiment down for the first time this year. Joining me now, global real estate advisor Jenna Stauffer. Jenna, good morning.
Good morning.
Good to see you here in New York City.
Wonderful to be here.
Yes, all the talk right now is that we're in a housing recession, are we?
So this year has just been so unpredictable. So rates, prices, they have totally moved against expectations. Instead of providing any relief to buyers, what they've done is they've sparked an affordability crisis. And we really are in one of the most unaffordable housing markets that I think we have seen in a really long time. And I know we keep hearing about affordability. I feel like affordability, I keep talking about it, but it's the buzzword because it is such a risk factor. So the housing market, it is central to the economy, and we are in uncharted waters. So we've never had interest rate hikes as sharp as what we've had in the past year and a half.
Well, Lawrence Yune's going to be joining me tonight on Maria's Wall Street show, and he's predicting 8% interest rates on the 30-year fix. I mean, that's the most popular mortgage in this country. You think 7% is rough for people. 8% is going to be just a brutality I think we haven't seen in years. So what does that do to prices? I mean, I'm assuming that that's going to really make a big difference and push prices even lower.
You would think that it would push prices lower, but it just seems like with the lack of inventory that we have, these prices aren't going anywhere. There's still demand to buy. There's still people who want to purchase homes, but there's no homes to purchase. Yeah. There's such a lack of inventory because you just have sellers that are holding on to those interest rates. No one wants to pay more for a house and then pay double the interest rate.
Yeah. Well, from July 2021 to July of 2022, the population in Florida, where you are, it grew to over 22 million people. How do you think, Adalia, is going to impact this idea that all these new residents that moved to Florida now realize, oh, I'm in hurricane country? Yeah. Is that a discussion, do you think, that's going to happen? Would that change the real estate story, do you think, in Florida?
So Florida always goes against what you think should happen after a hurricane.
That's true. Okay.
Florida is very resilient, and we've seen it now become the fastest growing state in the nation. Prices have just remained steady in Florida. And look at what happened after Hurricane Ian. Fort Myers, Naples, these cities just grew in price growth. So I just think that Florida will continue to remain that hot spot. So many people are coming down here from New York. They would much rather take on the risk of hurricanes, maybe take on higher insurance costs versus having to pay higher taxes like they have to pay in states like New York.
So how did your home and you're in Key West, how did everything fare down there with the hurricane? I know that you got out before the storm hit.
I did get out before the storm hit, but where I was located, we were very fortunate. It can always be worse. And thankfully in the Keys in South Florida, we we were able to escape any real damage.
We were just talking about Governor DeSantis and his response to the hurricane, and that the preparations were there.
They really were there, especially compared to Hurricane Ian. It seems like the preparations weren't there. We didn't know that the storm surge was going to be what it was, and so many people stayed in their homes, and that's why people really ran into so many challenges.
Final thoughts on the housing market. You know, the spring season was certainly not what was expected. I thought I would see more price drops, and we did not see that. We saw kind of a stuck market. What do you think about the rest of the year?
Yeah, so again, I think it's all going to come down to affordability and inventory. And I think we're just really in uncharted waters. We don't know exactly what's going to happen with interest rates, as you were talking about. They could definitely go up. There are indicators that inflation is cooling, but then there's also indications of strong economic growth, and that could put upward pressure on prices in the short term. And I think just being in these uncharted waters, the outcome of everything really remains unknown. So we'll continue to see this sluggish housing market.
All right. So you still think Florida is going to still be the top of the market? Because we are seeing prices fall in places like Austin, Texas, and Phoenix, Arizona. But
I think Florida, I think Florida's going to do well. But, you know, I do think that some cities in the Midwest, we're seeing Chicago now, they're really posting some price gains month over month. Cleveland, Detroit, these are cities that are more affordable, which is, again, what's driving the market. So you might see more cities in the Midwest where the cost of living is lower. They might do pretty well this coming year.
All right, guys. So a couple key points that she was talking about. I wanted to get you guys' opinion. No, as far as Florida, I don't agree with her in the same way about Florida. I know it's a bit cheaper compared to like California or New York, but anytime you like a market prices out the locals and prices out all the natives, it's not going to be able to sustain, in my opinion, because, you know, in order for that to be sustained, there has to be more and more people purchasing. So, you know, as the migration and work from home and all of that stuff, and we hit a recession, all that tampers down. I think places like Florida that were so dependent on the migration and people like spending money like crazy on second homes and speculation, once that ends, I think it's going to hurt. You know, I think it's going to hurt them. But, you know, here's the thing, what I really wanted you guys to pay attention to, and I hope you guys got it. You know, she was mentioning that she expected, as well as many people, even if they're bullish right now, expected prices to go down during spring and summer. You guys know that I expected prices to go down spring and summer, and they did not. They went and did the opposite. So, you know, why, right? I keep trying to tell you guys, like, what happened? Why were so many people wrong? And I really think it all boils down to this right here, you guys. This is the federal balance sheet. This is the balance sheet, you guys. And really, this is, in my opinion, why so many people were wrong. They created, you know, a false narrative. The Fed bailed out the banks right here. It shifted this. Do you see this downward line right here? It shifted this upward. So it shifted this upward 1, 2, 3 notches, right? So we're doing really good with quantitative tightening. And then boom, here's the timeline pushed out. So I look at this, guys, this run up in quantitative easing as you know, what pushed out the recession. This, in my opinion, pushed out the reset. And by doing that, you know, if for the people that are purchasing right now, they're not, you know, the ill prepared is going to really hurt. Is really what I'm trying to say. The ill prepared is really going to hurt. But, you know, I believe that's what happened, you guys. I think that's why, you know, so many people got this wrong. Okay. Now what I want to do is I'm going to start with our market analysis. I'm going to do this right here. This is a market analysis. Okay. So we're going to go into our value part of the video. So if you guys want to leave, see you guys later. Have a great day. But now we're going to start talking about value and start talking about things that will improve us as consumers. There is a huge disconnect, guys, when it comes to like what you think a good deal is and what the data says a good deal is. So this next part of this video, I really want you to focus on how I'm doing what I'm doing, because any realtor that has access to MLS could do the same thing. And it doesn't even take that long. And if you're a realtor and you don't do this, please watch what I'm doing so you guys can do this. And remember the most important thing about what I'm about to do, location. Okay, so, and I understand different areas, different cities, rural property, land, I get all that, but we're going to be talking about subdivision, because the market analysis and determining value, the subdivision is what matters, because different subdivision can be completely different. You can have $1 million houses in one subdivision, and across the street, $400,000 houses. The subdivision, you guys, is everything. So I will be completing this right here, and we will be going into the Houston Association of Realtors matrix, okay? So let's go. And remember, what I'm going to be doing is we will be doing this on the subdivision. I'm going to change this. I don't like the yellow. I'm going to just go back to green, okay? This is what we'll be doing. We're going to be doing this on Spring Terrace. So if you're in the Houston area and you're wondering what's going on with Spring Terrace, this is going to be a really good video for you. Now, remember, you guys, the first thing I have to do is I want to figure out these two things here, average price per square foot and the average rent as well, because remember, those are things that I need to do to equip myself to know whether or not I'm getting a good deal. We don't understand if something's a good deal or a price cut is a true price cut unless we have the data to back it up from comparable sales. Okay, so I'm going to be going back to here and we're going to get started right away. And I hope you guys enjoy. So first thing I'm going to do is we're going to figure out price. I'm going to do a 1-year history for price. So I need to look at all sold property. I'm going to just put for the last year, which is 360 days. I can be a lot more detailed if I was representing a customer. Again, here we're going to change this to Spring Terrace. So Spring Terrace, and I'm going to copy that so I can just paste it next time. Copy. Okay, it shows me that I have 23 comps or sold properties. So for the last year, Spring Terrace, 23 properties. I'm going to show results. Here's all the properties here. Now I want to do a market analysis, so I'm going to select all of these comps. Let me make sure there's no outliers though, real quick. I don't want to include like $1 million properties. Okay, good. This is all about the same. This is beautiful. So then I'm going to go down here to stats and hit tabular right here. And it's going to tell me price per square foot on sold property right here. So it gave me the active as well, but I'm just going to look at the sold. Okay, right here. Okay, so $133.07. So that's the first piece of information. I'm going to be putting that right here. $133. Remember, guys, this is just the bare minimum of how we can do this, right? You can also get an appraisal. That's what the lender does, is a lender gets an appraisal. They go out to the subject property subdivision generally, and they find 3 properties that are similar to the property that you want to buy, okay? So let's go back here, and we're going to get started now, and we're going to go back, since now we have that, okay? And then we're going to go into the rental matrix, and we're going to look at the rental market now. And we're going to do the same thing. I'm going to uncheck active. I'm going to hit sold for the last year. Now this is how we calculate cash flow. Go back to the subdivision, paste the technical subdivision. Okay, it gives me 28 homes that have rented out. I'm going to hit results. Here's all the houses here. See this? I'm going to select all of the data, hit stats, tabular, and let's see what they're renting out for. Cheap, 97 cents a square foot. So it's being rented out for 97 cents a square foot. Okay, square foot. So those 2 pieces of information alone, y'all, okay, those 2 pieces of information alone, now I'm equipped to look at the current market, right? So I know the last year average price for value, and I know the average price per square foot for, I'm sorry, the average rental price as well, okay? So now I'm going to go back here, and let's take a look at the properties. So I'll go to the subdivision, paste, Spring Terrace, 3. There's only 3 houses. There was 4 when I started this. This is crazy. All right, so let's see what we got here. Oh my gosh, you guys. Okay, so we know that the average price per square foot, what is this? Oh, I'm still in the rental market. Okay, so sorry. That makes more sense. Okay, I had to switch over to the actual homes for sale. Apologize. Let's go back here. 360 subdivision. Spring Terrace. Gives me 19 properties for sale. This is good. Dang it. Active properties. What am I doing? Okay, so active properties in Spring Terrace. It gives me 4. So here's the 4 properties. Remember, guys, I'm going to categorize this by price per square foot right here. Okay. Now I have the cheapest houses first. So I'm going to do an analysis on the first property, but I also want to remind you guys, remember, the bigger the property, the less price per square foot. So you can't automatically, think that you're going to get a ton of wedge if the house is double the average size. So even though this is for sale for only $101 a square foot, which means this is what, about 20% under market value or something like that. It's a huge, really, really highly under market value, but we can't really, say it's like a lot under because it's so big. All right, but let's look at this listing. So this house is selling you guys for $101 a square foot. Do you guys believe that they can build houses for $101 a square foot? Doesn't that blow your mind? I'm from Southern California. I never knew this was even possible. $101 a square foot. Okay, $101 a square foot. Now, what do I need to do here? Let me change my picture. I need to fill out the size of the house, okay, which is right here. This is important. The size of the house is 3,752 square. Isn't that a huge house, you guys? 3,700 square foot house right there. Isn't that a beauty? $101 a square foot. That's crazy. I'm writing all this down, by the way. Okay, let me go back here. Do you guys see how I put the size right here? And the purchase price right here? But remember, I also need to find out my taxes. So let's go back and let's find the taxes real quick. Right here. Taxes are $6,927, okay? So let's go $6,927. You guys see that right here? So now this is going to get really super duper easy because all I have to do is now multiply stuff. All I do, guys, is I multiply the average price per square foot by the size. I'm sorry about that, guys. Okay. So I'm just multiplying it by the size for the first one. So I take 3,752 times the square footage of $133.07 gives me a market value, which I'll put right here, of $499,278. Ton of wedge in this property, but remember, you guys, it's a little bit harder to do this because the house is twice as big, roughly, as a normal sized house. However, it's still really nice to walk in with wedge. Is anyone going to disagree with me? Now what I'm going to do is I'm going to figure out what the rent is. So I take the size of the house, 3,752, times the market rent of 97 cents a square foot, equals market rent of $3,639. Okay. Do you guys see now? Now we can figure out our wedge and cash flow once we figure out our payment. So now we have to figure out our payment. And again, when it comes to these bigger houses, guys, it's a little bit more difficult. So now I'm going to calculate my payment, and I'm going to go over here to do that. To Google, I'm going to put in mortgage payment. Calculator. Here we go. Include taxes and insurance. Remember, the home price was what, $380? We're going to put, what, 20% down? I guess we'll just put 20% down. Let's say we have really good credit. Geez, look at this interest rate. My gosh. All right, so let's change the property taxes because we know the property taxes are $6,927. Okay, there's no mortgage insurance. So here's our payment. Our payment would be $2,789. Okay. Now, it's literally that easy, you guys. That took us how long? I can't tell you how long it took us. Oh, yeah, here it is. It took us 10 minutes. That took us 10 minutes. I'm explaining this. So if I would have done this by myself, it would have taken what? 7 minutes? And again, guys, the bigger houses I'm going to do, like when it comes to like super big houses, I would like eliminate the smaller houses to do this. I would only like do an analysis on homes that are 3,000 square foot or bigger. But I'm about to show you guys now the wedge in the cash flow. And you guys, those are the two principles that I want you guys to learn as people that are purchasing your primary residence. I know even if you don't want to buy a house to invest, some of these tools with wedge and with cash flow will help you be better off. It will help you be a winner. So let's do it now. Okay. So what I do is, let me get my calculator. We're going to do wedge first. So all I have to do for wedge is I subtract the market rent, the market price of $499,278. So I subtract this from the sales price. Okay. So minus 380 gives me a wedge of, it's so important to understand this, guys, because if you ever have to sell or refinance your house, you want to have wedge in there. So this property has $119,000 in wedge. As far as cash flow, I would take the market rent of $3,639. I would take this here, subtracted by my payment right here at 20% down. Again, this is at 20% down. That gives me cash flow, gross cash flow of $850. Remember, guys, this is gross. There are expenses that will eat into that. So overall, this property is actually, well, let me tell you guys if it was me. Okay, so this property has a wedge of over $100,000. It has a potential cash flow of $850. And honestly, that's not bad, man. That's about 20%. It's actually more than 20% in equity. So, like, that's not a bad house. Let me tell you my concerns with the house. I love the wedge on this. First of all, the wedge is beautiful because I have 119,000 in wedge based on the last year. When the housing market starts crashing, it changes. But I want to start with as much wedge as possible if I'm buying right now. If I'm buying right now, much wedge as possible. I love it. 119 is a beautiful wedge. 20% is a beautiful wedge. Cash flow being at $850 a month, I love that too. Anytime it's like, I would look for $500 a month in gross cash flow. So I like it. I like everything about this house. Let me tell you the one thing that I do not like about this deal, and I do not like about this house, it's how big it is. Especially in Texas. Like, for some reason, guys, like, the big houses, they don't rent out as easy and they don't sell as easy. So if it was me and I was being conservative, because this is a big house, I would probably like cut all this in half. So I divide all this by 2 just to be safe, right? So like my wedge would be like 60,000 and my cash flow would be $400. Do y'all see what I'm saying? Now, again, it's just kind of a napkin math that I'm doing here, but we can't assume that we have that much wedge in cash flow necessarily when the house is so much bigger, right? So overall, I think it's a decent deal. I think that's actually a decent deal, to be honest with you. I would ask this person what they're paying in rent. I would ask them their down payment. I don't know if they have 20% down, but it's a decent deal. It's a decent deal. If it was me, would I take it? If it was in the area that I was interested in purchasing, I probably would, to be honest with you. If this house was in where I wanted to purchase, I might make an offer on that. It's $101 a square foot, guys. It's a decent deal. It's a decent deal. So we're starting to find, deals at cash flow. We're starting to find wedge. That's a really, really cool thing. Let me go into the last thing, guys. Let's do the Q&As now. So we're going to go into some like Q&A stuff right now, and throw some questions. If you guys have more questions, just type in question on the bottom and I'll try to get to that. Let me take this first one. Travis, what is your take on Florida and the uninsured in the recent hurricane and upcoming one? How will the uninsured market affect the current one? It's just going to affect it really bad. If homes are not insured and they get wiped out, then there's no homes anymore. It's just like a toxic waste dump. The lack of insurance coverage, especially in hurricane areas like Florida and Texas, is an absolute epidemic. It's a huge problem. It's putting people in a lot of danger. It's going to suffer. The housing market's going to suffer as a result. That's a fact. Here's another comment. My buddy is a mortgage loan officer. He said that 80% of mortgages started the last 2 years have been rate buy downs in FHA and VA. That's right. So, I always try to make the point, like, the lending guidelines today is nowhere comparison to the subprime. But that doesn't mean people could still afford their mortgages today. Okay. I'm just saying the guidelines are way different. But the more and more people that are purchasing at these high rates with no equity, the more damage, the more harm. Johnny's saying that the reverse repo market is dropping because the long-term yields are selling, and that's what I was thinking. So this is a customer, I'm sorry, this is a viewer, I say customer, that's basically saying they got an 8% at closing a couple weeks ago. Rates are high right now, you guys. They are super duper high. All right, you guys, let me see if there's any questions. We need a real estate mindset app. Ugh, I can't do it, you guys. Reventure, you check out Reventure's app. I can't do it. Although I've been looking at data visualization because I think it's really, really amazing. Okay. Other than that, guys, I'm going to get out of here. I hope everything is, I hope it goes well for you guys this weekend. Remember, just worry about you, be empowered by your knowledge, help other people, train other people. If you're on the sideline, credit, income, assets, become an expert in your local housing market, and don't purchase with emotion. And that's really, how I'd leave you guys. And have a great morning. Hope you guys enjoy my evening video, and happy Tuesday once again. If you're out there investing in real estate, you guys already know I wish you luck. And I hope you